We're jumping straight into Sibanye Stillwater today. Everyone is watching the price action, but the real story is the massive 198% surge in EBITDA and the operational turnaround in their U.S. mines.
Exactly. You're tuned into the Easy Money Show, where we make sense of the market's biggest moves. I'm glad you're with us.
And before we get into the weeds of this mining giant, make sure you take a second to subscribe and hit the like button.
It really helps.
It does. We're here to help you simplify these complex market moves so you don't get left behind when the charts start going vertical. And frankly, looking at Sibanye Stillwater lately, vertical is the right word.
It really is.
Yeah.
I mean, if you were watching the ticker last week, let's say around January 22nd and 23rd, it did not look like a typical mining stock.
No, it looked more like a tech stock or something on a tear.
A crypto chart, almost.
It was absolutely wild. You had a 7% jump on the 22nd, then boom, another 7.4% on the 23rd. We're seeing these consistent 5 to 7% daily swings.
And for a company this size, that's significant volatility. It's enough to give a standard index investor whiplash.
Right. But it's not just noise, is it? There's a real signal in there.
That's it, exactly. What we're seeing is the market trying to reprice a company in real time based on new information.
And that's what we need to unpack.
Right.
Because on the surface, it really does look like a perfect storm. You have these huge external factors, commodity prices going parabolic, and they're colliding with these internal fixes happening at the actual mine level.
It's like a ship that's just fixed its torn sails at the exact moment a massive tailwind hits. That's a great analogy.
So the big question for investors is this just a lucky break? Or is this a real structural shift in the business?
And when you look at that EBITDA number you mentioned at the top, that 198% increase, well, it suggests the engine room is finally working properly.
Let's start right there with the bull case, because the numbers are staggering.
They are.
That headline number for Q3 2025 adjusted EBITDA is $9.9 billion. For our listeners tracking in dollars, that's what, about US $560 million?
Roughly, yeah. And to put that 198% year-on-year increase in context, that's effectively tripling your operational earnings. That is just, it's right for a mature miner.
Right. And this is where we need to explain operating leverage for anyone who doesn't look at mining balance sheets every day.
It's key to understanding the story.
In mining, your costs, digging the hole, paying people, keeping the lights on, they're relatively fixed. They don't change much day to day.
Right. So when the price of the metal you're selling jumps, almost every single extra dollar of revenue falls straight to the bottom line.
And Sibanye is a masterclass in this right now.
Precisely. They are capturing that spread between a fixed cost base and a soaring revenue line. But we have to look at what they're selling.
It's not just one thing. It's the 4E platinum basket.
Mm-hmm.
Let's clarify that for the audience. The 4E basket is platinum.
Palladium, rhodium, and gold, correct. These are the platinum group metals, or PGMs.
And their South African operations are heavily weighted here. Right?
Heavily. And that segment saw an EBITDA increase of 213%. Just think about that number.
And why?
Because the price for that specific basket of metals is up 36%.
That is a massive move for a commodity basket. A 36% jump basically changes the economics of every single mine shaft they operate.
It absolutely does.
Yeah.
It turns what was marginal rock into high-grade ore, financially speaking. Rock that wasn't worth digging up 6 months ago is now pure profit.
And then on top of that, you have the other engine, gold.
The shiny stuff.
Gold is trading over $4,600 an ounce right now.
Which is a number that honestly still shocks me. It feels like just yesterday we were staring at $2,000 as this huge psychological barrier.
A different era. But because of that 35% jump in gold prices, Sibanye's gold operations specifically saw their earnings jump 177% to $3.7 billion.
So you have PGMs firing on all cylinders and you have gold firing on all cylinders.
It's rare, right? Usually one is up while the other is down.
Exactly. One often acts as a hedge against the other. Right now they are compounding each other. It's a dual tailwind.
Okay, but here's my skepticism. High prices can make bad managers look like geniuses.
That is the critical question.
Is Sibanye actually running the business better, or are they just lucky to be sitting on the right pile of dirt at the right time?
And the data suggests it's not just luck. This is where the operational execution part of the story comes in. Production itself is up 15% quarter on quarter.
So they are physically digging more stuff out of the ground.
They are. It's one thing to have high prices. It's another to have the volume to sell into those high prices. But the real story of execution isn't even in South Africa. It's in the U.S.
The U.S. PGM operations, these have been the thorn in their side for a while, haven't they? I remember reading reports about flooding, cost overruns.
Thorn is putting it mildly. The U.S. ops were a cash drag. High costs, geological issues. It was a headache that just ate into the profits from South Africa.
But not anymore.
Look at Q3. Post-restructuring, the U.S. PGM operations are profitable. They posted $33 million in EBITDA.
Wow. From a liability to an asset, that's a huge swing.
A massive swing. And there's a regulatory angle here, too, that's often overlooked. The Section 45X credits.
Ah, okay. What is that?
It's part of the U.S. government's strategy to secure critical mineral supply chains. It basically offers tax credits for producing these specific minerals domestically.
So the U.S. government is effectively subsidizing their cost base to make sure they keep digging.
That's it. It lowers their break-even cost and turns a marginal U.S. mine into a profitable strategic asset. That's a structural change, not a cyclical one.
Okay, so turnaround in the U.S., commodity boom, but we haven't touched on the pivot yet, the optionality.
You're talking about the battery metals.
Specifically, the Keliber project in Finland.
This is probably the most interesting part of their long-term story. Keliber is their big lithium project.
And it's set for completion in Q1 2026, which, looking at the calendar, is basically right now.
It is. And this isn't just about digging up raw ore and shipping it somewhere else.
They're targeting lithium hydroxide, right, the refined stuff.
Exactly. 15,000 tons per annum of lithium hydroxide. That is the refined chemical you need for high-performance EV batteries. They're moving up the value chain.
Which usually means higher margins. It seems like the big banks are waking up to this. I saw a note from HSBC that was incredibly bullish.
They updated their price target to $24.80.
$24.80. I mean, considering where the stock is trading today, that is.
Yeah.
That's aggressive.
It implies massive upside. It's a huge vote of confidence.
Okay, so if I pause the tape here, the story sounds perfect. Revenue up, profits surging, government subsidies, a lithium expansion. It sounds like a slam dunk. Why wouldn't everyone own this stock?
It does look compelling when you stack it all up like that.
I know. There's another side to this. You've got your lowdown notes ready.
You know the drill.
Yeah.
We have to do the lowdown. Because while that EBITDA growth is fantastic, there is an accounting reality check that we just cannot ignore.
Okay, lay it on me. What's the catch?
The catch is the difference between EBITDA and EPS.
Earnings per share, the bottom line.
The actual bottom line, yes. EBITDA is great for operational health, but it ignores interest, taxes, depreciation, amortization, and mining is a capital-intensive business.
So once you pay the banker, the taxman, and account for the wear and tear on all the heavy equipment, what's actually left?
Well, the company guided for a basic EPS loss of somewhere between 120 to 133 South African cents for the first half of 2025.
Wait, hold on. After all of that 198% EBITDA growth, record commodity prices, the U.S. turnaround, they are still technically losing money on a per-share basis.
Technically, yes, for that period. Now, to be fair, this is a massive improvement. It's about 55 to 60% better than the losses last year. The trajectory is right.
So they're digging themselves out of the hole, but they're not out yet.
Exactly, and that's a crucial distinction. You're buying the trend toward profitability, not the current state of it. You're betting they cross into the black very soon.
And that disconnect explains the war among the analysts. We mentioned HSBC at nearly $25.
But if you look at the broader consensus, the average analyst target is much, much lower, around $12 to $14.43.
That is a massive spread. One camp sees a double, the other sees, well, a potential 20% drop from here.
If that consensus view is right, buying today could mean significant downside.
So why is the consensus so much more bearish? Is it just the EPS numbers or is there something else?
It's the EPS, but it's also what the market calls the South Africa discount.
Geography. We have to talk about the jurisdiction risk.
We do. A huge chunk of their cash flow still comes from South Africa, and that comes with risks that don't exist in, say, Nevada.
You mean things like load shedding, power cuts?
Exactly. Power supply is a constant battle. Deep-level mining needs massive, consistent electricity. If the grid wobbles, production stops cold.
And what about labor?
Labor dynamics in South African mining are historically, let's say, volatile. Wage negotiations can turn into strikes very quickly, and that just destroy your margins.
So that fear is always priced into the stock.
Always. And we've seen how sensitive the stock is. We talked about those 7% jumps, but on January 16th, it just dropped 5.34% one day. Boom.
So you're signing up for that volatility.
You are. Some value metrics out there suggest the stock might be pricing in perfection right now.
And that's a dangerous place to be. It means the market expects everything to go right, and if one thing goes wrong,
the reaction will be swift and brutal.
Okay, so we have a very clear setup. The bull case is this powerful turnaround story. The bear case is valuation and jurisdiction. For our listeners, what should they be watching over the next 30 days?
There are two massive dates circled on my calendar. The first is January 29th, the strategy update.
And what are we listening for there, beyond the usual corporate speak?
We need to hear about CapEx, capital expenditure. The Caliber project costs a lot of money. Is the balance sheet holding up? Are they controlling costs?
So cost discipline.
In this environment, it's everything. If they show discipline, the rally could have legs.
Okay, so Jan 29th is the health check. What's next?
February 20th, that's the release of the year-end 2025 results.
The scorecard.
This is where the rubber meets the road. We know Q3 was great. Was Q4 a monster quarter too? They need to prove this is a trend, not a blip.
And if they do, it could force those skeptical analysts with the $12 targets to re-rate.
Right. Exactly. That could force a capitulation and drive the price even higher.
Any macro factors to keep an eye on?
Watch for news on the EU Critical Raw Materials Act. It's the European equivalent of that U.S. Section 45X we mentioned.
And that would be a direct tailwind for the Caliber project.
A direct tailwind. It would make their Finland asset more valuable overnight. And, of course, keep an eye on the platinum price. Supply is very tight right now. As long as that holds, the fundamentals are strong.
So let's wrap this all up. Give me the final lowdown. How should we think about this trade?
Look, this is a battle between two very powerful narratives. You have a massive operational turnaround meeting a commodity boom. That's one side.
And on the other?
You have serious valuation concerns and the undeniable geographic risk of their main operations.
It's the classic growth story versus the value trap.
It is. If you believe we're in a metal supercycle and that management can execute this pivot to lithium, then the stock still looks cheap.
But if you think commodities are peaking and you're worried about South African infrastructure,
then you look at that EPS loss, and it looks expensive and risky.
you know, it feels like such a pivotal moment for them. And that leads me to my final thought for today. We tend to put companies in a box based on what they were. Sibanye is a South African gold miner. That's the legacy tag.
Right.
But with the Caliber project coming online right now and the U.S. operations finally turning a profit, are we actually witnessing the birth of something else entirely?
That is the multi-billion-dollar question, isn't it?
Is this just a gold miner anymore, or are we seeing the emergence of a major diversified battery metals player that just happens to be funding its growth with gold?
Because if the market starts to re-rate them as a battery tech materials supplier, the multiple expansion could be significant. Tech stocks trade at very different multiples than old-world miners.
And that re-rating is the potential jackpot. That's all the time we have for today on the Easy Money Show. We hope this helped you make sense of the wild moves in Sibanye Stillwater.
Thanks for listening.
And don't forget to subscribe and hit that like button so you don't miss our next breakdown. We'll catch you on the next one.